I want to introduce a brand new strategy, takes advantage of gap continuation and reversals, a pattern we've struggled with, and I want to show you a little bit about that and how we've come up with this. Here is the equity curve. We'll go over the rules and results here. Why I came up with this strategy, I want to show you. Oftentimes we get this gap down, continuation, and then we get some short trades going, and then it reverses on us. And so oftentimes we can catch some big trades if it continues to the downside. And so this gap continuation and reversal though does kind of the opposite, not the opposite, but it looks for a pattern to take advantage of the opposite of that, the gap continuation. So the market previous day closes here, you get a opening price down here, so you have that gap down, continue, and then reverse. And so oftentimes we talk about gap fills. A gap fill is when the market closes here one day, the next day it opens higher and then fills that gap, goes towards that gap fill. Or if it opens lower, it goes towards that previous day's close, typically right away. A gap continuation will close here one day, open higher and go, or open lower and go. And now this gap continuation and reverse is kind of a gap fill delay, a delayed gap fill. So market closes here, it opens higher, and instead of filling right away, it continues and then reverses, kind of a head fake, or it goes down, continues, and then reverses. It tends to do this more so when it opens down. So oftentimes when the market opens down and continues, it reverses because there's a bias to the upside. Since the trend in the stock market is higher, the fundamentals of the Fed are higher, and a lot of dip buyers, and the trading psychology of a lot of traders is to buy those dips. And so that's what we're working on, that's what we've worked on, and that's what we have today, what we've released. This uses a $1,000 stop loss. You see the largest losing trade. We don't have slippage and commission, but there is an average trade net losers and winners of $188.09. So we typically take out $25, plenty of room, lots of room for slippage and commission. Really big average trade profit for a day trade strategy. We're going back to 127.16. It works further back than that, but the drawdowns get bigger than 3,000 after that. So we're looking at recent results over about almost 5 years, and the bias is to the upside. It is long only. Profit target at 2,000, and we don't do this if the market is down more than 1%. The current price is down more than 1%. Catching a falling knife will be the risk there. Markets that are down further than that can reverse. It just gets to be wilder at those points, and you have to have bigger stop losses. And so a little bit of risk control here by not doing this if the market is down more than 1%. And so I really like this strategy. I don't know why I have not come up with this approach before. I talk about daily how this gap continuation, reverse, and chop. And so I say it's hard to find that, and it is, but we have something now, and we're going to implement it. I think it's going to improve the diversity of the portfolio quite a bit. And so I want to take a look at adding this to the portfolios and putting it in the portfolio calculator first and testing that. It'll take a little bit of time. And so keep looking for this as an update. This does hold trades right until 1 minute before the close. 16:14. At 16:14, it sells or buys next bar on close. We've tested the short side, and the short side, since we're biased to the upside, we don't take short trades unless this is up more than 2%. And I'm going to show you that, the results if this is up more than 2%. So turned off the longs, we have the shorts only, and because we wait till it's up more than 2%, there's not nearly as many trades. So the market is biased to the upside. If you try to short a move that's up 1%, you're going to get blown away a lot. And so you have to really wait till it's up 2%. And what's beautiful about this is since 4/29/20, the Fed stimulus occurred on 3/23, right back here. Let's see. There's not a lot of days where this is up more than 2%. The market's up more than 2%. So this is the Fed stimulus. And so the first part of the Fed stimulus, the market soared higher. So imagine you don't want to short. You would not have wanted to short 2% move up because it went straight up after it went straight down. But after it had run a little while for 2 months, just about a month. So 1 month since 3/23, First month, market surges higher. You don't want to short it at all because of Fed stimulus. Since that time, 2% move higher has been almost a sure thing. Short period though, not many trades. Let's look at the record. November this month has done really well, 48.25 on 4 trades. So not a lot of trades, 3, 4, 5, 6, 10 trades. 10 trades total in April, May, September, and November. There weren't even 2% move higher after a gap up in July and August or October. So you have to wonder though, could this be an opportunity to short the market? If you're looking for an opportunity to short the market, this could be it. I recommend when I release this probably to just trade the long only side, and I'll show you that again. So here is the long only side once again. You see since the beginning, January 2016, this has done incredibly well. Only a $3,000 drawdown before slippage and commission. Be a little bit higher than that with slippage and commission, and it hasn't done terrible. I thought it worked better than this. Originally said it worked before that. It doesn't really work before that, but it doesn't do terrible either. So we talk about that in our webinars. We look for strategies that have worked further back or at least don't do terrible. Higher levels of volatility can sometimes take a break-even strategy like this, and when you get to higher point values and higher daily average dollar ranges, then you can see an equity curve that can do this on some strategy. So here it is. Even with that long flat period, 81.96, it meets our threshold of about $50 average trade profit that we want to at least see for the minimum. But since this time frame, you have about 188 before slippage and commission, about over 150 after slippage and commission, which is 3 times the average trade profit that we want to see. So nice results. Happy to have this strategy, and I look forward to updating you with this latest strategy for your trading.